Well, the Federal Reserve made their decision to not raise interest rates due to the concern of turbulence from tightening, since we've had one rate increase in about a decade this past December, which sent the worst start to our stock market in its history in January. So it's probably a good thing they didn't raise rates. And also the very concern of slower than expected global growth has had them actually scale back the idea of 4 rate increases to now the probability of 2, which I would predict would likely mean no more increases. If anything, I would think we'd see a polar opposite change of likely even reducing. And that has a lot to do with the revised retail sales numbers that came out this past week. And again, doesn't make a lot of the media headline because they came back in weaker than what they said they were when they first announced them in January and February. Ultimately, translation being consumers are not consuming near as much, retailers are struggling, the global economy is struggling because of weaker consumption, and there's not a chance that the Federal Reserve can afford to raise rates and put the markets into more of a turbulent tailspin. So what does that mean for us? That means when the first quarter's earnings reports come out here very, very soon, unfortunately, I think you're going to see a massive market downturn. Now, I hope I'm wrong. Don't think I'm going to be. And I feel that this is the time to really be thankful for this February, early March run-up and get your money and retirement savings locked in and protected. I had the opportunity to speak to a group of local radio listeners in the Orlando area this past week in launching my book, The Baby Boomer Retirement Breakthrough. And it's fascinating to me because I think many people relate to this. One particular couple had an odd scenario where there was no of any kind survivor of the larger 2 Social Security benefits, and there was no survivor benefit to the wife's teacher's pension. And so they had some serious pension protection planning that needed to be involved. But the big thing was all of their retirement money, as predicted, was locked up in accounts that have been tax deferred, which means the tax to get the money out is going to be higher than the tax they thought they were deferring by putting it in. And so what I want to teach you is this coming Tuesday, I'm excited to teach you how you can safely more than double your retirement income by just changing the order of the way you're doing things now, we find with typical baby boomers, as well as how to increase an additional $500,000 to $1.2 million of additional retirement savings without changing your budget a dollar different tomorrow than what it is today. And if that sounds too good to be true, put me to the challenge. Register at retirementprotected.com. That's retirementprotected.com, and let me teach you how you can safely lock in your serious retirement savings and prevent the next market downturn or turbulent, torrential downfall before that takes place. But more importantly, not just as a safety net, but as a way to outperform the market with indexing, not investing at the same time, and not only not subjecting your retirement savings to loss to the market, but no loss to taxes. Get Uncle Sam out of your IRAs. Register retirementprotected.com, retirementprotected.com.